What if I told you that you can retire early? And it's not by working more harder, but by investing more smarter. Many people think that retiring is something you have to do in your 60s or on your way to like 65 years old. But with the right strategy, you, my viewer, can achieve financial freedom quite earlier. In today's video, I'll be showing you how something like a money market fund can help you retire early. Of course, with low risks, steady returns, and high liquidity. Stay tuned. Hi everyone, welcome back to my channel. My name's Miss Wangui Muithathi, and here we talk about smart money moves, investing, and things like wealth building strategies, stuff that will help you grow financially. So, if you're serious about achieving financial freedom, make sure to like, subscribe, and turn on notifications so you don't miss out on any future videos. So, today we are talking about money market funds, one of the safest and the most reliable investment options for you or for anyone that is looking to retire early. But before we dive in, let's first understand exactly what they are. What are money market funds? A money market fund, or in other terms, some people know it as an MMF, is a type of low-risk investment that pulls money from different investors and invests in things like short-term, high securities, for example, treasury bills, or you might know them as T-bills, commercial papers, government securities, or bank deposits. They are known for low risk compared to other investments, for example, real estate or something like stocks. They are also known to give you steady returns, which is higher than a traditional or a normal savings account. It is also known for high liquidity, and this is because it's one of the investments where you can easily access your money, okay? In case of something like an emergency, a money market fund gives you that benefit. Now, let's see why they are a great option when it comes to early retirement or retirement in general. Retiring early requires a balance between safety, returns, and liquidity. And that's exactly what a money market fund offers you. Okay? One, it comes with low risk, which is equal to financial security. Unlike something like stocks, which can be very volatile, money market funds provide stable and predictable returns. So that's one of the things you need to put into consideration. This makes them perfect for retirees who need steady income. Sawa sawa? Another reason why a money market fund is perfect for your retirement, it comes with passive income for early retirement. Instead of keeping your money in a savings account, a money market fund generates passive income through interest and dividends. That's something you will not find in a traditional normal account, okay? And you see, over time, this can cover your living expenses in early retirement. The third advantage is liquidity. This is quick access to your funds. Unlike fixed deposits or real estate, you can withdraw your money without penalties. You know, you can always count me in. Mali hakuna penalties, just count me in. Sawa sawa? And this is very crucial for retirees, especially the ones who need financial stability. Some people would ask, but how much do I need to invest in a money market fund so that I'm able to retire early? Let's break it down. To retire early using a money market fund, you need to calculate the following. 1, your annual expenses. Do the math and find out how much do you need per year. How much money do you use? Find out what your expenses are worth. Okay? Another thing you need to calculate is the expected returns from a money market fund you choose. And this is because most funds offer 8% to 13% interest rate in Kenya. Some go lower, some go higher. It really depends. These are things that really fluctuate. But roughly between 8 to 13. Yeah. The third thing you need to consider or calculate is the fourth rule. This is a safe withdrawal rate for financial independence. A simple example calculation is you need 1 million Kenya shillings to retire. If a money market fund offers you a 10% annual return, you'd need at least 10 million shillings invested to generate 1 million shillings in passive income for you. Okay? So if your expenses in a year is 1 million, you need to invest at least 10 million shillings in a money market fund so that every year you get 1 million. So remember, the more you invest, the earlier you can retire. Now, let's look at how you can maximize your returns in a money market fund. For you to get the most out of a money market fund, you need to follow these strategies. 1. Reinvest your earnings. This is something like instead of withdrawing your interest, reinvest it instead to grow your money faster. Number 2, compare different funds before investing. Look at things like interest rates, fees, and something like withdrawal policies before investing in any specific fund. Okay? Those are factors to consider before you choose any fund. So, number 3, use money market funds as part of a diversified portfolio. Don't put all your eggs in one basket. Combine money market funds with things like stocks, real estate, and something like bonds for a balanced investment strategy. Number 4, choose funds with high returns and low fees. These are things you shouldn't take for granted. Remember, when it comes to wealth building, every coin counts. So if you can save a coin here and there, do it. So, and this is because fees can eat into your profits. So always be alert. Always check expense ratio. But before you invest, here are key factors for you, my viewer, to consider. For instance, minimum investment amount. Some funds require a high amount, some require a low amount. So check out a fund's initial investment, okay? Don't be caught unawares. Another factor to consider is interest rates trend. Money market funds returns can fluctuate due to market conditions. The third factor is inflation versus money market funds returns. Ensure that the returns outpace inflation over time. And lastly, consider withdrawal rules and fees. Some funds limit how often or how much you withdraw. Okay? Let's wrap this up. Money market funds are a very powerful tool when it comes to early retirement. As I said earlier, because they offer low risk, steady returns, and high liquidity. But the key here is to start early. You have to start early. Okay? You also need to keep reinvesting your returns. Whatever you earn, don't be quick to withdraw it. Reinvest it. And last, don't forget to combine or diversify money market funds with other different investments, especially if you're looking to build long-term wealth. Diversify but don't spread yourself too thin, okay? 3 to 6 investments are great. Sawa sawa? So you might find yourself out there feeling like maybe it's too late, but as soon as you get the information or you get to know, start. Don't beat yourself up because you didn't know earlier, okay? It's never too late. Anyway, what's your take on money market funds for early retirement? Let me know in the comment section. Well, I hope this gets to help someone. If you'd like to see more videos like this, don't forget to like and subscribe, and you'll be notified once we upload another new video. Thank you so much for watching, and see you next time. Mwah, kisses. And kisses.